I believe it's 7 o'clock, and I see we have a quorum of the Finance Committee, and I'm going to open the meeting. I want to remind everyone that the meeting is being recorded. So we'll begin with our agenda. The first item on our agenda, we have 4 available minutes. Have folks had a chance to review those? I know that these came out the last 2 days, so I'd like to move as many of those minutes as we can. Let's see how they feel about it. Do we have any comments on the minutes from March 14th? Okay, I have on page 5 of those minutes, I have one comment. Let's see if I can find it. March 14th, I believe it. Okay, under the Article 24, I would just like to see a little bit more detail as to it does not seem to follow that we are talking about this, and then in the response to a question from Ms. Hartman, it was explained that the Concord Housing Development Corporation is a private nonprofit entity. So I think the only thing we need there is a clause that sort of says, because the Concord Housing Authority is mentioned in the article, Ms. Hartman asked, what it is, or something like that. It just seems kind of like a non sequitur sitting in there, that's all. And on page 6, thought I had something. And that's all I have, is just that one comment. Anyone else have a comment on March 14th? Okay. Can we have a motion on March 14th minute?
I move that we accept the minutes as written with one change.
So we'll take Mary, would you like to second?
I will
that?
second that.
John will second. Mary moved it. Any discussion?
Did you hear that, Anita?
Mary moved it. John seconded it. Any discussion? All in favor?
Aye.
Okay.
Abstention?
One abstention.
I mean,
Okay.
yeah, 2 actually.
Okay.
Three
So
I wasn't
okay. So to be clear, you are allowed to vote on these even if you did not attend. That's just the rules. It seems counterintuitive, but those are the rules. So you don't have to abstain if you don't want to.
Got it.
Okay. The minutes from April 8th. Does anybody have any comments on the minutes from April 8th? This was a short meeting. It was the one we held prior to town meeting where we had the somewhat counterintuitive vote that we took.
Yes.
I don't see any comments. Do I have a motion on those minutes?
I move that we accept the minutes as written.
I have a second?
I second it.
Christine seconds it. Any discussion? Okay. All in favor of accepting the minutes?
Aye.
Any abstentions? Another abstention. Okay, we have an abstention. The minutes are now, the next minutes are those of April 25th. Are there any comments on those minutes?
I do, Dean.
Yeah, okay.
On page 3, the paragraph that starts with Mr. Guariello commented, the last portion of the statement says, and I was drawn to joining the FC following the town meeting. That's actually incorrect. I was already talking to the moderator at that point, so I'd just like to strike that portion from the minutes.
Just that last clause?
Yeah, and was drawn to joining the FC after town meeting.
Fine. I have one comment. It's not actually... I'm sorry, on page 3 of the April 25th minutes, we're going to, strike that last clause on the paragraph that says Mr. Guariello, and it says, and was drawn into the, it's just a sort of technical. I do have a comment on this, and that is, I believe, at the top of page 2. This is just something that we may want to just keep in mind in this meeting when we get to the agenda item under our policy items, and that is Mr. Packard noted that it was announced that the SGR would be published by early July. I'm just noting that that is something that that's in these minutes, and I'm just making a point. There's no change to the minutes as I think they're written. So, are there any other comments on this set of minutes? And I think we're ready for a motion.
So I move that we accept the minutes of May 23rd with the amended change.
Second it.
Second? Second. All in favor?
Aye.
Any opposed? Any abstentions? Oh, no abstentions on that one. Okay. We're going to move on to the minutes of May 23rd. Any comments on this set of minutes? Well, okay, that's a good set. Can I have a motion?
I move that we accept the minutes of May 23rd as written.
Second?
All in favor?
Aye.
Very good. Unanimous. Very good. Okay. So next up on our agenda is a discussion with Peter Fraser, who has got his PowerPoint ready and his projector pointed at the screen above us. So we come join the table, find a microphone so that the folks at home can hear you.
How about this one? Thank you very much.
I'll just let you know this is a little challenging for us on the board itself. We're going to have to follow along on the paper. So if you don't have the paper copy, then
Yep.
very good. Thanks.
Everyone?
Yep.
Yes. Great. I think I need one.
It's going to get
This is mine, I think.
Oh, that's yours.
There
Nope.
are plenty more.
It's available. Here's one.
You need one,
You
Dick?
need one, Dick?
Yeah.
Here we go.
Couple back
I got
there.
one.
the presentation was sent out.
Mr. Fraser, these microphones are really finicky. You have to get right up close
Okay.
to them.
Thank you.
These were sent.
There's another copy. Somehow there, too.
Ready to go?
Yep.
Great. Well, first, thank you very much for taking time to let me address this group. I want to thank Carrie LaFleur for the invitation. As you know, the town recently sold bonds. You're a frequent issuer, and every time you issue bonds, you get your bonds rated by Moody's Investor Service. And so what I'm hoping to do tonight is talk a little bit about, sort of get everybody on the same page as to what bond ratings are, what the value of the ratings are, what some of the criteria are that the rating agency looks at, and then talk specifically about or entertain questions about your specific rating report that you received. In terms of your handout, you've got copies of the slides that I'll be showing, as well as at the back is a copy of that rating report that was produced in conjunction with the recent bond issue. Just to step back and by way of introduction, again, my name's Peter Fraser. I'm a managing director in the Boston office of Hilltop Securities. I work with about 80 Massachusetts cities, towns, districts, and authorities in terms of helping them through this borrowing process. Our firm in the Boston office works with about 180 Massachusetts municipalities and literally thousands nationwide. I've had the privilege of working with Concord for 33 years now. You wouldn't know it by my hair color, but and it really has been a privilege and a pleasure. I don't want to ruin the surprise, but you guys are in terrific shape. You have a AAA bond rating, which is the highest rating attainable, and are arguably in the handful of the top strongest credits in the state. So with now that I've spoiled the surprise, I hope you'll stick with me for the rest of the presentation. In terms of sort of understanding what a bond rating is, it's simply an opinion of a bond rating agency as to their judgment of the creditworthiness of an issue, a bond issue or issuer. And that bond rating is used by market participants, whether they're underwriters, the folks that originally lend you the money by underwriting your bonds, and also investors, as a shorthand way of determining relative value in terms of the worth of those bonds in the marketplace versus everything else that's out there. And the rating is paid for by the community, but when you think about it, it's really as protection for the investors. So they have a sense when they're buying your debt about how well they can sleep at night, how safe an investment it is, or at least that perception. In terms of bond ratings, the ratings that are in the next slide are Moody's and Standard & Poor's, and they're the bond rating agencies that do the overwhelming market share in Massachusetts, as well, quite frankly, as nationally. And these start out at AAA, that's the highest rating you can get, down to Baa3 for Moody's and BBB- for Standard & Poor's. And the idea is these gradations are the higher the rating, the lower the perceived risk, and therefore you get a better interest rate because there's a trade-off between risk and reward. So for you folks being the highest rating attainable, you'll always be getting the lowest interest rates in the market at the time you issue. There are actually ratings below the scales that you're seeing. Those are referred to as non-investment grade or junk bonds. And fortunately in Massachusetts, no municipality is rated below investment grade. As a matter of fact, we're on average the highest rated, our local municipalities are the highest rated as a group in the nation. In terms of, so how it works is these are yield curves by rating, and when you think about when you guys go out to borrow money, let's say you do a 20-year bond issue, unlike a home mortgage, which is a single amount that you're borrowing, you're actually borrowing 20 individual loans that mature 1 year apart in a series, and there's an individual interest rate tied to each one. So that's, you can sort of see there, and with the legend, you can see across that 20-year period, each bond that's being issued, and a yield, by the way, is the rate of return to the investor that is essentially lending you the money. You can see that the AAA curve is that bottom curve, so you're getting the lowest interest rates as you go up or go down the scale to the weaker credits, AA, single A, and BAA. You can see that they're paying more for their debt. They're getting higher interest rates than the AAA. In terms of trying to quantify that, so we've established that higher ratings mean lower borrowing costs. It also means that you have greater market access in terms of I'm sorry.
I have a question on the yield curve slide.
Sure.
If you look at least the bottom two, and it's more pronounced on the lowest curve,
yep.
There's an inflection point at about 5 years out where, could you explain?
Sure, and these yield curves were taken from a couple of days ago, and the relationship, both in terms of what's referred to as the quality spread, the interest rate difference by rating category, is not static. So that will change over time, as will the slope of this curve. We're looking at a very flat yield curve right now. In other times, you will have very low short-term interest rates, but perhaps very high long-term interest rates. We're at a much flatter yield curve at the moment in terms of that. And so these sort of undulations, this is a snapshot as of a particular day, but they will change over time and the difference can be very dramatic. So I'm sorry.
And does the inflection point vary? Might it be 3 years out? Might it
Sure.
be 10 years out?
Absolutely. Absolutely.
And what typically accounts for that difference in slope? Change in slope?
It can be expectations in terms of the economy. If the idea is you think that the economy is going to be taking off and there's going to be an inflationary pressure in the future, that might tip the scale up. If the economy appears to be slowing and the feeling is, the long end of the curve starts to come down, it gets pushed down because there's a perception that there won't be as much inflation in the future, perhaps.
So back to this chart, just one other question. So the AAA line, it stands by itself, but the other three lines appear to be mashups of three different rating levels. Is just a median of those?
Exactly right.
Okay.
Exactly right. So in terms of sort of what's the value, we talked about the fact that higher ratings give you lower borrowing costs and better market access. And to try to quantify this, and this is just order of magnitude stuff because all of these numbers are in flux, but to give you a ballpark sense on a typical or a hypothetical $10 million 20-year bond issue, the difference between you having a AAA and if you had a AA is about $250,000 over the life of the loan. But if you were in a single A, it'd be about $1.5 million. And if you're at the BAA category, the lower rung on the investment grade, there'd be about a $3.3 million difference in terms of the interest that you're going to pay on that debt over the life of the loan. So clearly there's an incentive to want to maximize your credit rating. Do those things that you have to. But the other value, I think, is that it's an unbiased expert assessment of how the town's doing. And we'll get into the credit factors, and I think you'll see what I'm getting at. In terms of the major credit factors that the rating agencies look at, they're looking at your economy and your tax base, looking at management, looking at your finances, and debt and contingent liabilities. And debt or the contingent liabilities refers to your pension obligation, your unfunded pension obligation, as well as your OPEB liability. So that gets thrown into that category. And you can see the percent weightings that, and again, these aren't perfect, and it's not formulaic completely, but this gives you a ballpark sense of how they weigh those major factors. Getting into, sure.
So these factors are basically components of some sort of algorithmic thing. So to return to your point on the previous slide, unbiased expert assessment of a town's well-being. During the financial meltdown, 2007, 2008, it was pointed out that this, so to speak, unbiased assessment was sort of a feedback loop. People are paying to have their bonds rated, the payment is coming in, and the rating agencies are complicit in jacking up ratings. Is that been squeezed out of the system at this point?
And I totally appreciate what you're saying. I don't think the muni market was really the target for the real dollars were in the collateralized mortgage obligations and those more sort of sophisticated products that we found out the rating agencies really didn't have a handle on. Right. What that risk was. But for municipals, I don't think one, because the fees are much lower, that there was the same sort of financial incentive to do that.
So I guess my actual question is this sort of a hands-off thing run by an algorithm, or is there some secret sauce expertise that's being stirred in to sort of tweak the number at the final, when it finally is done?
There is.
Okay.
And it actually has quite an impact, as we'll get into when we walk through the various categories for your own report. So So in terms of the kind of things they're looking at when they're talking about economy, it's local, regional, national, even global economy plays some role. Your tax base, what the composition of your tax base, what the size of the tax base, how much is commercial, industrial, how much is residential, how's it growing or shrinking? Looking at employment, looking at demographic figures, your wealth and income levels, which obviously in Concord you are blessed with a very affluent tax base. In home values, they'll look at building permits because they want to see that that's sort of a predictor of growth. In termes of management,
Excuse me, I just have a question. It's hard to hear with
and I
your-
apologize.
Yeah, that's all right, that's all right.
Got my back turned to you.
With regards to under economy, again,
Yep.
the composition, Concord's primary tax base is residential.
92%
So can you just,
approximately, yep.
can you just tell me or retell me what you said about the composition in terms of the value of having a high residential and a low commercial versus another option?
Like most of the criteria, it can be a mixed bag, where in some communities being essentially exclusively residential would be perhaps a difficulty because any new expenditure that has to be taken on goes right to the taxpayer. If you've got a wealthy residential tax base with a history of debt exclusions and overrides, essentially getting around the limits of Proposition 2.5, it can actually be a positive, because you're more insulated from business cycle fluctuations, where in some communities that have a large commercial industrial component, it takes pressure off the residential tax base, which is a good thing, but might make them subject to that volatility that recessions can bring, for instance. Does that make sense?
Yep, thank you.
So in terms of management, we're not just talking about the qualifications and experience of the managers, although that's important. What the rating agencies want to get a hold of is what your procedures and policies are. Do you have a history of robust budgeting, forecasting, capital planning, that sort of thing? Do you have policies with respect to reserves or your investments or debt? And also they want to know how frequently are decision makers monitoring the performance, whether it's budget to actual or what kind of investments and you have and where they're located. So they look at a whole mix of those in order to sort of sort out their weighting. With respect to finances, they're looking at liquidity, sort of what your cash position. They're also looking at your reserve position and the composition of your fund balance, whether it's unassigned, meaning essentially available for appropriation, or whether it's committed or reserved. That's a little harder to get at if you needed to. What your stabilization fund balance history looks like, as well as whether you're structurally balanced. And by that I mean, are you generating sufficient operating revenues to cover your ongoing recurring operating expenses? The notion there being, if you have a history of using reserves to balance your budget, that would be perceived as a relative weakness. Because if you run out of reserves, then where are you going to be? That idea. And reserves are really important. One, it's a measure of financial flexibility. It provides resources for unanticipated expenses. And when you think about bond ratings, what they're talking about is kind of what's the likelihood that you're going to default or delay payment of an obligation to investors. So to the extent that you have significant reserves to draw on, that means in the event that there's a bump in the road, you're still going to be able to make those payments. It also, reserves help stabilize town employment. You don't see layoffs and then hiring, as well as disruption of delivery. So that's another reason that they weigh reserves heavily. Obviously, they also generate interest income. Those reserves are sitting in the bank or in some investment generating interest. And it also enhances the market access and therefore lowers borrowing costs.
When
Sure.
you're referring to reserves, you're referring to free cash
Free cash, stabilization, yeah,
and stabilization.
yep.
Question about, you had said that this is an indicator, or you're looking for the capacity to meet obligations and not. Can you just comment on how your firm is treating the overhang of OPEB in all of the communities that you're servicing? It's a huge outstanding liability that is just threatening every community. And
Yep.
we're doing pretty well with it, but it would be nice to just hear what your broader perception of that is.
Sure. Generally speaking, OPEB is a huge liability. The thing that's been sort of a positive is the rating agencies didn't have enough information sort of on a comparable basis to really understand exactly, there are underlying assumptions associated with what that liability is and how it's going to grow over time, sort of predicting what inflation, medical cost inflation is a pretty tricky thing. Recently, there are GASB accounting rules that say you have to now put that liability on your balance sheet. So there's more comparable information that is out there. It's a huge number. Relatively speaking, though, you guys are in really pretty good shape compared to most. There are a lot of communities out there that haven't really started to fund their OPEB liability. You guys are about 25% funded, I think, from the last, you've got, about 11 million or more in your OPEB trust. So that's a pretty good start on a $42 million liability. The other sort of corollary to that is the pension, unfunded pension liability. You guys are in very good shape there at 85% funded. You've got about, 10 more years or so on your funding schedule. So relative to most other communities, you're way ahead of the game. And you have some flexibility built in there in terms of, by statute, you could stretch that out to 2040. And so you've got some slack in the system. Not that I'm suggesting anybody should do that unless they absolutely have to, but that is perceived by the rating agencies right now as a relative strength of Concord. They're also looking in terms of your debt, how much your absolute debt load is. Right now you've got about $52 million worth of outstanding bonded debt. They drill down deeper, though, to try to understand, well, what's supported by a Prop 2.5 debt exclusion. So because that's got a revenue source outside of the limits of Proposition 2.5 to service that debt. They're also looking at your self-supporting debt, any water, sewer, CMLP, or the fitness and the swim and fitness, the sort of recreation enterprise that you have. And they'll tease some of those numbers out of their metrics that they're looking at to focus on that debt service that is funded by taxation. They're also concerned about the amortization, essentially the length of time that you guys borrow. You've been very disciplined over the years and have kept that amortization short. For a lot of construction projects, for instance, in Massachusetts, you can borrow for up to 30 years. You've tended to keep the amortization short so that it rolls off more quickly, so that you can add on new stuff without it being a direct burden to the taxpayer, which I think has paid dividends from a rating perspective. They look at offsetting aid or subsidy in the case of MSBA projects, school projects. That can be a significant offset. And as I mentioned, they also look at your unfunded pension and OPEB liabilities, not only in the aggregate, but how you're amortizing that as well.
Peter, I have a question on the pensions, which is, doesn't Moody's try to level the playing field from town to town? And I think they do that by the discount rate.
Right.
Can you tell me what discount you're using?
Sure. The question is, with respect to pension, different pension systems have different assumptions about what kind of rates of return they're going to get over time. And if you have an assumption that's a very high rate of return, your present value of that amount that you owe is going to be less. So it sort of, in some respects, would incent you to say, oh, I think I'm going to make 9% on my money over time, because that means I don't have to contribute as much now to fund that liability. What's happened over time is a number of communities that have been more conservative, if you will, or prudent, have lowered that rate of return assumption, but that means it's blown up their the present value of their unfunded liability. And so, by doing that, you're being more conservative, but it means you've got to pay more out of pocket. And to your point, sorry for the long-winded lead in here, but to your point, if you have a number of different communities that have very different underlying assumptions, you have to somehow normalize it in terms of saying, well, let me take your data, but have everybody assume, say, a 3.5% or a 6%, whatever that may be, to kind of normalize and then figure out, so you can compare apples to apples from one community to the next. And I can't tell you off the top of my head what the current formula is, because it's pretty opaque in terms of, but they do give metrics that sort of is their determination of what that number is, and then provide sort of ranges that they think is sort of strong, less strong, and weak. But
I think they were using an expected rate of return.
Yeah, can you get a microphone? Thanks.
I think Moody's was using an expected rate of return that they were applying to all towns was considerably lower than the expected rate of return, at least that we were using.
yeah, but again, it's not so much to tell you what your liability is as to be able to compare folks. So it's not intended by Moody's, and they even have a blurb in their rating reports to that effect, this is the way we kind of compare folks. It is not our estimate of what truly is your liability or what your payment stream will look like.
Before you continue,
Sure.
One other question on amortization. If you think about municipalities, I'd like you to think about, when do you raise a yellow flag in terms of that little bucket called amortization?
I can give you an example of Standard & Poor's looks at, if you're amortizing 65% of the principal outstanding within 10 years, you get the highest possible notching score in terms of that. By the same token, it is very unusual, particularly with the large school projects that we're seeing, where folks will not go out to the maximum, which would be 30 years.
They will not?
They do go
They
out.
do go out.
Just out of necessity for the taxpayer's benefit.
So then how does that impact the rating? Credit factors, that credit factor.
Yeah, like many of these things, no single factor tips over the rating, unless your fund balance was really diminished. So the thing is, when we're looking at all these things, you sort of put everything in the pot and stir it around and figure out, is there enough on a cumulative basis of these sort of relative weaknesses to push you into a lower credit rating. But it's I don't think it's possible to accurately say, well, if we maxed out on our amortization, that would change our rating. I can almost guarantee it would not, because when you look at all of the other AAAs in Massachusetts, a lot of them, Belmont's got a $300 million school coming down the pike, Arlington's same ballpark, 2 AAAs. There are a lot of communities that really have quite a bit more debt than you guys do, and at maximum amortization, and it hasn't affected their rating. Sure. Yes, sir.
So, how long has Concord had a AAA rating?
I think 1987 was when you were upgraded to AAA. That's off the top of my head, but I think that's about
So,
right.
for the last sort of 40 years, we've had AAA. And how much, off the top of your head, has our sort of general financial situation been better or worse than it is today? So, in other words, if you're looking for a floor of some sense, right, how low was it in the last 40 years and we still maintain AAA?
Again, and I ruined the surprise up front, you guys are incredibly strong. You've got superb management and always have. You're a very affluent, educated tax base, and the why I say educated tends to mean that the communication is better, that the buy-in is better, people understand the relationship between investing in the community and their own home values, as well as quality of life. You haven't had a lot of debt from the metric standpoint. So, you guys have hit a home run sort of in every aspect. So I don't think that there's any material sort of weakness or anything, the pressure on the rating. The one thing I should say is it assumes that you're going to continue to maintain strong reserve levels, and some of the other things are a little harder to change in terms of the home values and wealth levels and those sorts of things. But you benefit from being at the top of the heap.
So were we AA before that? Was it
Yeah,
a gradual increase
I want
over
to say
time?
you were AA in the mid-'80s, and since then you've been a AAA.
All right, thanks.
All right, I sorry to interrupt. I just have one more question. You mentioned something about access to MSBA funds as being affected. What did you mean by that?
Oh, simply that as you may know, that certain school projects are eligible for Massachusetts School Building Assistance funding, and it's on an eligibility basis, and basically, and the Concord Carlisle School is getting, I think, close to 36% on that project, and so you guys are benefiting for not having to do the financing for your full share because the state is paying some. And so they factor that in. It used to be that the municipalities would have to borrow 100% of the cost and would get aid payments on an annual basis over the life of the bonds, in which case they would factor that subsidy in to reduce the amount of debt for their calculation. They don't do that now because you get paid as you build, as opposed to getting ongoing aid payments on an annual basis. Does that get you? So, and I apologize for this, but it's in your packet, which is the last page of the rating report. And Moody's just started this new scorecard, and I think they may have some regrets about it, in connection to your comment about things were opaque and subject to criticism. One of the things that the rating agencies did was try to become more transparent in terms of their process, less of a black box. And one of the Standard & Poor's came out with an indicative rating application where you could feed in a bunch of statistics, if you will, and it had spit out what the approximate rating was subject to certain notching. And Moody's is doing the same thing here with this new scorecard. It's a little bit, I'll be honest with you, I have some problems with it simply because if you take that first example, for instance, tax base size, and they're saying for a tax base of your size, which is about $6.5 billion, that somehow translates to a AA, where it, and if you look at their data, by the way, I provided Carrie with an electronic version of their sort of criteria and methodology, so if you really want to do a deep dive, she may be able to email that to you and you can go through, which has some more of these metrics. But, you know, in order to be a AAA tax base, whatever that means, you'd have to be 12 billion or greater. Now, in terms of Massachusetts, we've got 15 AAAs in Massachusetts, and I think only Boston and Cambridge would fall into that category. So
what is the difference between economy/tax base and tax base size?
well, economy/tax base is the heading, and then within that, there's tax base size, full value per capita, and median family income.
30% weight.
And just to give you a sense of why they can show it this way and then come clearly out as a AAA, you guys, in terms of full value per capita, which is essentially the equalized valuation of the community divided by the number of people in town, is $371,000 per person. And the cutoff from their standpoint in terms of a AAA is $150,000. So they're looking at these metrics from a national standpoint. So although for some reason they think your tax base is too small to be a AAA, you guys are 2.5 times what the cutoff would be in terms of being a AAA for full value per capita. And median family income, you're more than twice the U.S. median. So anyway, there's to the point earlier, there's a little back and forth, but clearly you guys come out on top. Another example of that, which is kind of you have to dive deeper in terms of finances, fund balances, a percent of revenues at 24%. If you look at nationally, the AAA metric would be 30%, having fund balance of 30% or greater of revenues. But in Massachusetts, because we're so affluent and we're dependent on very stable revenue sources, which are real estate taxes and state aid for the most part for most communities, the sort of need to have much larger reserve positions is mitigated, whereas in some parts of the country, if you're dependent on sales tax or if you're dependent on energy taxes that can be very volatile, you want to have a bigger financial cushion to protect you. One of the things that I take issue with, and talked to Nick Lehman, who's the analyst who did your latest rating and is the head analyst in Boston, talking about the 5-year dollar change in fund balance as a percent of revenues at 3.4%. The 25% is the AAA metric, which to me is kind of meaningless, because what it means is you would have to grow your revenues more than your expenditures by 25% every 5 years, which is crazy, because if you had 50% reserves and you just maintained, you'd get a lousy score from their standpoint. Whereas if you were at the rock bottom and were digging yourself out of the hole, you'd get a great score. So anyway, I think what the way he described it is, for their purposes, it's more of a flag than it is, because if you see this great growth or drop off in terms of the revenues over expenditures, that it clearly is something that you have to look at more closely. For you guys, it isn't something that you have to worry about in terms of that, or it's the cash balance, because you guys are maintaining and consistently have adequate levels of reserves, and although you tend to grow those reserves incrementally, you're not going to have that incredible growth.
Simple question, what's the difference between a cash balance and a fund balance?
Well, your cash position would be, in terms of your balance sheet, your cash and investments, as opposed to fund balance, which is essentially the equity, and that would be made up of your unassigned fund balance, your restricted fund balance, your committed, and your assigned fund balance. So one is a liquidity measure, and the other is sort of your reserve position or equity position.
So, Peter, you touched on 2 of the 4 areas that Concord is rated single A.
Right.
And it doesn't sound like you think those are areas of vulnerability
No.
to the town, at least the 2
Correct.
that you touched on.
Yep.
The fund balance is percent of revenues and the operating revenues over operating expenditures. It doesn't sound like you think those are areas of vulnerability.
No.
What about
and they don't either, quite frankly. I think this is a creature of the way they've constructed their new scorecard, and whether that will change over time, it may, because I think they're going to have a lot of pushback from, quite frankly, from communities like you that are very strong in all respects and have this sort of concerning presentation, because it really does take an explanation to kind of sort that out.
Thank you.
Question, Peter?
Sure.
So you're saying this is a new tool, the report card?
Yep.
So does this become then an established baseline for Concord? I mean, how do we baseline where we've been, and where we are?
Sure. My preference is every time you guys come to market, you prepare a preliminary official statement that has sort of all this data and much more in terms of trends and that sort of thing. So it's pretty easy for us to provide you, if you were to say, what's our trend in terms of our AV growth, or the composition of our tax base, or fund balance, or debt, whatever that is that you'd be interested in, is probably already in this document. Did I answer your question? I'm not sure.
I think so. I mean, it just seems like it's good. If we're AAA now, that's a good place to be.
Yep.
Right. But that's based on a report card, a set of metrics, which we should kind of codify as a baseline to walk into. So in future years, when we're looking at our numbers, we have a sense of where we stand relative to where we were.
Sure.
Fall into that codification. It's like, we don't know where the goalposts are.
Exactly.
Yep.
And how are we supposed to benchmark? So one thing for you to say, this is the new tool, and then all of a sudden we start benchmarking to this, and then 5 to 10 years ago, the goalposts change, and then metrics.
But I would.
Running after something different. So I'm just trying to understand, how, when something like this happens, this is a big change. How does this get solidified, or how do incremental changes communicated in a way that's going to not be detrimental to respective municipalities?
Sure. And when I say it's new that they're actually publishing it. It's not new in terms of their methodology or the kind of things that they've looked at sort of forever. So it isn't a change, except for the fact that now you can see some of the data that they look at. And so again, my concern with this is not that it's going to hurt communities as much as it's going to concern ones that say, geez, we're AAA, we're doing everything right, and you're scoring me as an A on certain categories, because they'll admit that, just ignore that. That's really meant for us in the event of there's some drastic change going on with the community. It'll light up that particular metric, and then we can sort of explore, well, why are you growing your revenues so quickly, or why are they dropping so much?
But isn't it also true that what we see here is a snapshot of facts, not the thresholds, minimum thresholds in each of the categories?
Right.
And so, it would be, I think, improper to use the numbers up here as a baseline, because in many of these numbers, we could have been quote unquote lower and still ended up with a AAA rating, right?
Exactly.
Right.
Yep. And to be honest with you, I think you have a pretty robust set of financial policies as well that have guided you thus far and very well. So, in any case, so the just to wrap up, and I don't need to wear you out with all these other items, but you guys are in great shape, and you continue to be, to the extent that we can provide you with more information. Again, Carrie's got the electronic version of that Moody's methodology, which really gets into all of the breakpoints that they have for each of those. But you have to take those with a grain of salt, because even if you're, as you can see, in a single A category or a double A category in some of these things, it doesn't translate. And there is some notching that goes on that's sort of the human factor in this process, where they will look at you guys and see the quality of things like your financial statements and your budgets and your capital planning, your operating forecasts and so forth, as well as the history of that superior performance. And that weighs into their rating too.
The last 2 lines are kind of reflecting the last 2 lines.
In terms of notching
How we go
factors?
Yeah.
Right.
So just to put a practical note on this kind of analysis, in our budget cycles for last year, our regional school district was, they were tussling with their budget, and they were concerned about their excess and deficiency versus how much they should spend on OPEB. And they literally had multiple conversations at the school committee level about how the rating agencies would see whether they spent any money funding their OPEB liability, or whether they spent, saved money by not drawing down so much from their excess and deficiency, which is their free cash position. And they came to the position that the rating agencies highly valued available funds as opposed to the liabilities that they would incur by not funding their OPEB at the level that the town was sort of encouraging them to. So this is something that's really coming up, and we are trying to manage our way through this rating process while at the same time managing budgets. We're managing to the numbers, so to speak, and that happened in our last budget cycle. So people are watching, and it's important to us.
Yep.
So.
I have a question.
Sure.
Was this rating triggered by the fact that we were issuing debt, or is it done routinely?
Exactly.
And my other question is, can you do a what if for us? In other words, if we said, what if we were to go out and do, a capital project or capital projects that were worth over $100 million, what would that do to our?
Sure. We can look at that, and with that sort of analysis, it really depends on what the revenue sources are that will support it. And let me back up and answer your questions in order. The reason we got this rating report was because every time you go to the bond market, you really need a credit rating, because your market access would be diminished. You'd pay a lot more for that debt if it was unrated. So that's the reason for that. In terms of frequency of monitoring, you guys are a frequent issuer, so it sort of comes up every year anyway. But if you weren't, typically the rating agencies now, as a byproduct of the problems of 2008 and after, will surveil your credit whether you're issuing or not once a year. So they'll be looking at you to update so that they don't find themselves in a position where, the famous one was Worcester County was rated AAA for a long time, and then woke up one day and it was BAA, which is the lowest investment grade. So it dropped all of those notches overnight, and it was simply because the rating agencies hadn't kept up. They were an infrequent issuer and weren't surveilling them frequently. So, and that really undermines the confidence of investors in the rating too, because if they don't think they're doing it, so then now they're doing it once a year. But
So you would do it routinely, is what you're saying, periodically?
we were, not to confuse our role, Hilltop Securities, we're financial advisors. We help you guys through the process from the germ of an idea and modeling what that debt will look like, all the way through the rating process, putting together documentation with the help of Carrie and her team, and then get the bonds sold and follow up with capital planning help and that sort of thing. But the rating agency is Moody's or Standard & Poor's. They're the ones that that are actually looking at all this data, and they meet as a committee after having either a site visit or an interview process. Usually it's about an hour of talking with the municipal officials, combing through all the available information.
But that would be after the town had approved us going out and actually raising debt. What
Exactly
I'm asking
right.
is a slightly different question.
Oh, I'm sorry.
If you could help us, if we were looking at debt.
Yes.
Before we even went to town, and we were
Yep.
trying to determine, could this impact our bond rating?
Yes.
Can you help us do that type
Absolutely.
of analysis?
Yep.
Not to get into the weeds too much, but
Sure.
as you described the line item for, was it tax base size and full value, we're at, 6.5 billion. You had mentioned that some of the other towns that actually have AAA ratings at 12 billion, some of the AAA rating towns in the state of Massachusetts have a threshold of about 12 billion. Did I understand that correctly?
I'm sorry, I wasn't clear. The tax base size, this is methodology that Moody's puts out. And it says basically for AAA, you're greater than 12 billion. For AA, you're 12 to 1.4 billion. Less than 1.4 billion is single A. We have communities in Massachusetts that are less than 1, that are still. So all it's suggesting is that from their methodology, they look at it as size means that, you have a larger base to spread whatever the costs are over. But, the example that they use is Detroit. So Detroit has a AAA tax base? I don't think so. If you drill down,
No, right.
it's in tough shape. So it's this balancing act between, okay, well, inherently that should be good. We got to go deeper than that and look at some of these wealth indices to figure out, is it a strong tax base?
Sure, and the underlying question was really about the quality of the base, and I was really trying to if you could just opine a little bit about the difference between, the quality difference between commercial taxes and residential taxes, and how you think about that, because for us, the town of Concord, we have less of a commercial base,
Right.
more of a residential base.
Yep.
I'm thinking of Arlington, or I'm thinking of Cambridge, which has a much different composition. So from a qualitative standpoint, can you just give us a little description of how those two tranches are viewed?
Sure. There's no sort of absolute good or bad. I think there, as I was mentioning before, there's advantages and disadvantages to both. And the sort of the classic Moody's Massachusetts AAA is a bedroom community that is 90% or more residential. And that's simply because those are the wealthiest communities, the Westons, Wellesleys, Concords, Wayland, Winchester. But that doesn't mean that that's necessarily better than communities that have a more mixed tax base. It just means that for you guys, you can't rely on other revenue sources besides the residential base to get done, to pay for what you want. So I don't know if that's helpful.
No,
but-
I understand what you're saying.
Well, thank you for coming in.
Well, thanks
It's
for
been
having me.
very instructive. We have a clearer understanding of where our bond rating comes from. Well,
I,
we appreciate it.
I'm sorry if I blew your agenda time there, but
Well, it's-
thanks for
it's
having
fine.
me. And
We'll-
if there's
we have,
anything else that I can help with or additional material to provide, please let me know.
Nope. Thank you so much.
Thanks.
Thank you.
Thank you.
You're out of here. So, Mr. Tarp, so we're just going to assign you to the most things on the next point of the agenda. So that's fine. We'll talk. The next item on the agenda is, it says discuss and finalize observer assignments. I made some assignments. This has been passed out. Your name will be, you'll find your name on the left-hand column, observing some committee and possibly two committees. If you have a problem and find that the assignments I've penciled you in for are problematic, let me know. There are other issues that I face here, and that is that we have 25 committees to cover. There are 15 members, which means 10 of us have to cover two things. I have identified 3 committees which I believe can be monitored very tangentially. You could just monitor the agenda, and if the agenda appears to have anything that would be of a financial nature to the town, then you can go to the meeting and attend. But otherwise, I was a member of the Natural Resources Commission. It rarely has any activity that really has a financial impact on the town. There are a lot of private filings. People want to build a deck or they want to modify their backyard in a wetlands area, and that's not really that of interest to the Finance Committee. So there are 3 here that are identified as having an agenda monitor, and there are other assignments. The one that I have listed as a team there has 3 members. There are 3 committees there. There's the Concord Carlisle Regional School Committee, the Concord Public Schools, and the Minuteman Voc Tech. Those are 3 distinct committees. They meet on different cycles. So there are 3 names associated, and if we can coordinate, I've got myself penciled in for one of those positions. If we can coordinate among ourselves, we can just make sure somebody is in attendance at any one of those meetings. So I do have some holes, and if anyone wants to raise their hand and say, I can take another assignment, I will. You can talk to me after the meeting. One, I think I would move, Wade, I have you on Concord Housing Authority, but I think I'd rather have you attending the Affordable Housing Funding Committee there. I think they're going to be more active in terms of what they're bringing to the town or what's going on in there. And the Housing Authority, I still need a volunteer for that. So I think that's probably, given the holes that we have, that's kind of where we are. So I'm not going to spend a lot more time on that. As I said, just contact me, send me an email, and we can navigate if you can't do it or the assignment that I gave you was, I did pretty well. Everybody gave me 3, and most people got something on their list. There was 1 or 2 assignments where I just gave somebody an assignment that was not on their list, but that's not that many. So we did pretty well. Okay.
Can I just mention one thing, and that is, if you're assigned to a committee, you need to get in touch with the committee to get on their
agenda,
their email list.
Yeah.
So if you've been assigned to the library committee, let the chairman or the whatever the administrative person is for that committee know that they should put you on their list. You're
right.
The FinCom observer.
Right, and then you'll be on their mailing list. You'll get their agendas sent to you ahead of the committee meeting, and you can review them and be ready to listen. Okay, so we have 3 major things that we do here, and I've identified a little process review section. It's 8 o'clock. I'd like to take like 15 minutes for each of these just to go through and understand and see if there's some modifications we want to make with this year. I'm going to start with the 5-year tax projection and what the methodology is for that. Parshar took me aside after the meeting last time and had some very instructive comments, so I thought I'd at least bring those to the table. This process has been done historically. It was initiated in 2012 as a result of a citizen petition to town meeting that we engage in this 5-year tax projection. And the way we've envisioned it and executed on it has been to take our whole annual budgeting process, and when we finally arrive at operating budgets that will be moved at town meeting, this goes through the guidelines effort and everything else, and everything is sort of, this is what's going to come to town meeting. We presume that if those operating budgets were passed, this is what this year's taxes would be, and we then project out some estimates for what's going to happen in the future. It's done through an Excel model. The committee is presented with about 10 different metrics that they sign off on in terms of what we want to use as estimates. Some of those estimates are absolute numbers. Some of them are percentage growth numbers for healthcare costs or debt interest rates and things like that. There's a 6 or 8 different metrics that we project, and then we plug those into the spreadsheet and issue a static 5-year projection, which has a high, a median, and a low projection line for the next 5 years. It's a very static process, and Parashar has brought to my attention that we might want to think of something a little more dynamic, where we anticipate what would individual warrant articles do to the 5-year plan if this is passed, or if we pass this debt, or if we take on additional obligations. How would that model react? We don't do it that way now, and it might be something that we want to think about as we go forward, but it would take some revision of the modeling. Last year's effort was the first year that the finance department took that on. That was previously all of the Excel modeling, and the effort to create it in the first place was done before I joined the committee. I took it on. Wendy Ravelli was in charge of it before I got onto the committee, and I took it on and became in charge. I made my own modifications to the model. Everybody adds their own 2 cents. And I'm happy to have additional input, but as of last year, the finance department has done the actual modeling exercise. And so we want to maybe sit down with Carrie, John Harris, and talk to them about what might be some additional ways of doing it. I'd be happy to forward the model. Is anybody interested in looking at Excel? Does anybody want to raise their hand? No? Okay. Parashar. So Parashar and I will consult on what we might want to think about in terms of how that's done today, and maybe I'll have an offline meeting. We'll get together and sit down and go over it. Okay. So that's really all I have on that. Does anybody else have any ideas on the 5-year tax projection?
In this here, in the write-up.
In the Finance Committee report, yep.
The Finance Committee report, it did talk that there was not any information on long-range capital planning. And so with some of the new committees that are formed or the committees that exist, there will be, I anticipate there'll be some other information available. So how could we factor that into this model? It's just something to consider, how to factor it into this model.
The major outstanding thing, and we struggled with this last year, and we just let it lay on the table. Yeah. The major thing that this model, fails to understand is what would happen if we were to take on a debt issuance. And if large debt issuances are even on the warrant, the model does not actually add them. So they're only added when, in the year following, the finance department now has an actual debt schedule that we can add to, because debt schedules are actually added to the model as absolute schedules. We just take what the finance department has and add the debt schedule, and that's how it's done. But we are going to need to think about what can this model do to predict how these large debt issuances that we're anticipating will affect our tax rate. It's something that we have avoided. We've just sort of closed our eyes and said this model does not do that, and it, as a result, has sort of failed to accurately project our tax increases because we have taken on some debt.
Thank you.
Yep. So the next item on the agenda is a guideline review. I'm going to turn it over to Mary. She's produced some, ideas about things that we might want. Hopefully I got your model here.
You did.
Yeah.
Thank you.
I just highlighted it so some people could see what's going on.
Great.
And so I'm going to turn it over to Mary and have her discuss some ideas.
Thank you. Just to get everybody grounded, I'd like you to all just turn to the page where it shows items to consider for expanded guideline process scope. It's all numbers.
Is it before the guidelines?
Okay. What page is
Looks like a
that?
spreadsheet, but keep going. It's way after the
Oh, here it
minutes.
is. It's after the minutes.
It's after the minutes, and it's after the topics.
the guideline letter topics.
Right,
Okay,
so-
all right.
Everybody there? Great. So just to give especially the new people on the committee a feel for what the guideline process is all about, I've broken down total spending for fiscal '20. And the total spending, as you can see, is roughly $114 million. And out of that, it can be broken into two categories. One is the guideline spending, which is we do it through the guideline process, which I'll talk more about. And that's about 77% of total spending. The big spenders there are the town, the Concord Public Schools, and the regional high school. So out of those three budget entities, they cover about 77% of our total spending, and they are part of this guideline process, which is a conversation that we start soon. The rest of the spending out of that $114 million is something called non-guideline spending. So it's not part of that ongoing conversation we have with budgeting entities as far as what are their thoughts, what are their priorities, how is this going to impact property taxes, and and we don't issue a guideline to them to kind of live up to or try to come within so that we mitigate the impact on property tax. So Dean asked me to put together what are the categories that are non-guideline spending, and kind of highlight for us today things we might want to consider, including in guideline spending. And by in guideline, I mean including in the conversation that begins soon and continues through till the warrant is published. So the big articles in non-guideline spending are, first of all, debt service, and debt service is the principal and the interest we pay on our debt, and that's about 10%, 9.69% of our total spending for this fiscal year. Stabilization funds, what that refers to is the use of stabilization funds to fund our operating budgets. So last year, for example, we authorized some headcount increases in the town budget that were in fact funded through stabilization, so that was outside of the guideline process.
Just a quick note that it says emergency services. That in particular is a specific fund that was tapped to get those 295.
Right. And
So just a quick question on that. It then is the assumption that line item, the stabilization fund, emergency services, does that go into the town budget or into, I guess, the town budget the subsequent years?
it goes into the town budget to fund those people, but it wasn't part of the guideline process.
Right, but would it be part of the guideline process in subsequent years? Or is
Eventually-
this just a one-off?
Eventually, when we no longer have any money in this fund, and these particular, whatever expenses now need to be funded in the operating budget, yes, then it will become part of the guideline.
Okay, thank you.
Okay, going down, we've got OPEB, about 1.49, group insurance, group health insurance, which is 5.23, and then the rest is kind of a mishmash. We highlighted things that we thought the committee might want to discuss, bringing those into the guideline process. So the first thing, obviously, is debt, the debt service at $11 million. So what are your thoughts on that, Dean?
Debt service is something that we have traditionally really faced up to individual warrant articles. We look at, see, this is where the distinction between the guidelines, which is a budgeting function, and a debt issuance, which is a warrant article individual discussion, there's like a break there. We don't really have a mechanism for bringing these, we'll call them side warrant articles, into this guidelines process. They are distinct standalone votes, and they don't behave in the same way as sort of the budgeting that we tend to try and encourage. So I'm really not sure how we can, wrangle them to the ground. It's just there's a
But
problem.
is that what this is? Because I think this is what our committed obligations are, right? This is just debt service. That's
Yes,
what
but
that is. So
in order to manage this, we would have to be looking at, new debt issuances
Sure.
to manage what this number is.
Right.
So if we're saying, that's something in the middle of this
Carrie
town.
has, Carrie has
Carrie
something,
has something.
some clarification.
Yeah.
So I just wanted to put a little bit more information on the table about the distinguishing factors between the two categories, especially for the newer members who haven't been through the budgeting process for us. So the non-guideline spending, from the town perspective, we consider that those are fixed costs. And it's not that the committee can't discuss those, it's just understanding the difference between a debt service schedule where we have an obligation to pay that.
Yes.
Because debt has already been issued and it has been through the public process, it has been approved at town meeting, and these are just the costs associated with those decisions that have been made by town meeting. The retirement, that is the assessment that's given to us by the retirement system. So it's not that we don't want to talk about how that was derived. That's something coming from an outside force, and we don't have, we can't say, well, we'd like to pay 98% of that because we think that's reasonable. State assessments are the same thing. So in this fixed cost category, the non-guidelines, there's really a combination of things that are truly fixed because they have been decided by previous town meetings versus some things like insurances. We got into insurances where the management of the town is making a decision based on whatever process it needs to go through to determine what level of insurance coverages are being provided. So it's not that you can't talk about it, but it is something that there are external forces placed on that and different than just the typical operating budget.
So,
Sorry.
But benefits, so, I mean, the benefits are also the result. So OPEB and other insurance, other liabilities that are actuarially determined are the result of decisions that management makes,
Yes,
right? So
absolutely.
I think we would like to have some discussion around the input that ends up with that math.
Yeah,
right?
and I do think that's reasonable. I just would want to make sure the committee understands how those decisions are made, and once they're made, what the implications are.
so a question, because I agree with what you just said, right? So, in the normal guideline process, do we ask the departments and the schools about capital expenditures as well as, geez, what are the future debt service costs going to be? Or do we not ask that question?
We don't.
And that way, we should start doing that.
We should.
Right? Because then you can determine the impact, and again, the model can be a bit more dynamic in terms of how much the dollars are shifting from what we call mandatory spending to discretionary spending.
And one of the reasons why we should do this is because the capital projects are much more haphazard. As Dean said, they come up as warrant articles, but people are amending them at the last minute right up until town meeting, whereas we've had months of back and forth on the operating budget. So that's very deliberative.
That's right.
But people are, saying, I think this costs like $2 million. Well, maybe it'll cost $750,000. Whatever, they go back and forth. But $2 million and $750,000, that's a big deal. Whereas, we talk about a difference of $5,000 or $10,000 on the operating budget. And we go over that carefully. But we're very loose with the capital.
Well, we've let time run out. That's the problem, right? So we spend all, we do it much later, right? So if we could accelerate it and have the discussion on capital planning much earlier and maybe spend less time on I know, but ask for a change. Spend less time on the operating budget and more time on capital planning. Have it more balanced, I guess.
If you want to have a 5% increase in this operating budget, maybe you can't have a brand-new boiler or something like that.
Right, but you want to have the conversation at the same time. We don't, right?
I'm thinking right now that the select board has an idea to put together this long-range capital planning committee, and I'm wondering if, Dean, help me here, how would the work of the long-range capital planning committee maybe dovetail into what we're trying to accomplish here, which is to have a conversation in one place where we look at what debt do we have currently on the books, what debt are we thinking of.
Well, what you're suggesting, which is probably, I'm going to just go here and say it. We, in the guidelines process, we invite each of these entities, the town, CPS, CCRSD, in to come in and describe their operating budget. It might make sense for us to bring the long-range planning committee in as a fourth entity and say, what's on the table? What do we see?
But we also asked these three entities, CPS, CCRSD, and the town, to say, what are your capital plans?
Right.
Because every year there's multiple capital projects in the budget, which we don't really deliberate over, and which, as I said, are pushed to the very end. We run out of time at town meeting, and people are amending them at the last minute. If we
One
started
issue is, see,
asking
the
now,
guidelines are supposed to be they're supposed to be guidelines, so they're supposed to be issued really
Good point.
ahead of
Proactively.
the budget,
Yes.
proactively.
Yeah.
Of course, we have issues with how that actually works, but that's the thought, is that it's supposed to be before the budgeting actually takes place.
But it's not done in a vacuum. It's done after we've had a conversation with the spenders as far as what they see coming
Yeah, but
down.
it's still
What are mandatory?
certainly before their final budget, because we're always
Yes.
30 days ahead of when they're supposed to finalize it. But one thing, that I've always had a problem with is these additional, the labor burden, the costs, because we do deal with that, with the labor costs in our guidelines process, and, we're hiring X number of new people this year, but we don't see the real number.
No,
We only see the salary. We don't see the increase in workers' comp and, so on.
That's a good point.
That's a really good point.
Because that is absolutely not part of it. We see the budgeted salary component, but all of the other support components fall into this grouping of group insurance, pension liability, et cetera. So that we might want to think about some methodology for creating an all-in number for personnel ads.
Right.
For
incremental or for existing?
Well, we'll have to think about it. I think that's something to make a note on.
Well, you can sort of add a certain percent to the salary that
Sure.
represent the burden. Yeah.
But let's go back to the debt service. I'd like to hear maybe from is it okay if we hear from the select board people here to see if they think
If they
there's a
feel
way-
they want to say anything.
anything? Do you want to say anything about if you think the long-range planning, what is it called, long-range planning committee could take this?
I guess what our concern is that we would like to have any new debt that's coming on inform our process of issuing guidelines for the operating budgets, that there's some balancing act that we would like to include. Is that?
Yes.
Yeah. And while we might not find it formally, or we may be able to place it somewhere on the models that we use that help us during our deliberations, it's going to be a challenge to issue any kind of debt guideline, but we need to have some information so that we can be informed as we tussle with the operating budget.
And as when we issue the guideline, remember, we're looking at the impact on property tax. So I think that knowing what the debt that's coming down the pike, what that will do to the property tax would be information, but that would be valuable to let the townspeople know. The simple way to do this would be to simply, when we send out our guideline letters, to add to the guideline letters, please give us the list of your capital that's coming down, and also to add what is the burden on your head count. That would be the simple way to do this.
Fully loaded.
I'm sorry, the burden on what?
The fully loaded head count.
Oh, the French benefit. Yeah, French.
Mary, you'll be doing draft guideline letters.
I will. In fact, that's
So-
the next thing
That's the next
on the
thing.
agenda.
Yeah.
Yeah, I marked up a draft of the old one. I can give you
Oh,
my
no,
comments.
That would be great.
She provided some paragraphs here
Okay, so the 3 pages before this schedule.
before this
the 3
schedule
before the
are
schedule.
just some preliminary paragraphs that could be added. These aren't the full letters, but we just wanted to get out in front of this and add some color to the...
So again,
So-
the 3 pages before this, the Excel spreadsheet that you just looked at, is actually a list of the topics that we ask the 3 budgeting entities to come in and talk about. So this is really just a draft, so I would ask that everyone look at these topics and see, are we missing anything? Do you want to add or delete anything? And do I have it in the correct order as far as the priority of the information we're looking at? From what I heard tonight, I'm going to add the burden to headcount and also specific capital. And I think we have asked for capital, but we
It's
haven't.
their capital assets.
But we don't give it the attention we
But
should.
the question I have, and maybe Carrie could answer this, so if one of the departments comes along and says, or fire department wants $100,000 for a fire truck, are you able to predict what the future service costs will be to service that debt, or is that something you can't predict at the time? Because that's really the key that we're looking for, right? Because that'll impact the future operating budget in terms of the amount of money that's available.
Well, it will impact the debt service.
The debt service.
The debt service, right.
Operating.
But, well, it will to a certain extent because you've got certain limited tax revenue and you've got to decide how much of that is going to go to the debt service versus operating funds.
Certainly impacts spending.
Yeah,
Okay, yes.
fair enough.
So I can tell you required debt service payments for anything that we're currently servicing by individual item, and then for our 5-year capital plan. And I think the difference, again, for the newer members, we do have a 5-year capital plan, but we're really identifying the smaller items, the fire trucks, the land purchases, not the middle schools, not the fire stations, and that's the difference. But for anything that's included in our 5-year capital plan, we do have projections on debt service by project by year.
So if it goes into, if we go to the fire department and they want $200,000 for a new fire truck, you'll be able to tell us in November, December, geez, they want $200,000, and oh, by the way, that will come with a debt service obligation of X dollars for the next 5 years or 7 years? Because that's really what we need.
Yep, I certainly can tell you that. The way that we have a guideline for capital spending, again, for smaller items, where we have a policy that says our debt service in total will be 7 to 8% of our annual budget, our debt service payments. About 5% of that will be for the items that we finance. So we would finance a truck. Typically, anything that's over $100,000, we're financing over a period of time. So we're really working in terms of trying to keep a steady state with our capital so that there aren't fluctuations in debt service payments for our capital program.
So the fact that right now, in this year, our debt service is 10% as opposed to the 7 to 8% guideline is because of warrants that were passed at town meeting that were outside of the 5-year capital plan. Is that correct?
So I think the debt service number here would be inclusive of the
Excluded
district,
debt.
CCRSD, and that is not part of our 7 to 8% target.
So, but that's a target you have,
Yeah.
right? So, I guess during the process of putting together the budget, suppose you accumulate all the capital requests coming in from the departments, and it exceeds your target of X percent, and it's, say, 9%. Do you go back to the departments, and who goes back to the departments and says, hey, collectively we're over our target?
That's the town manager's
Right.
So
call.
the town manager is doing that before they're submitting the final budget to town meeting?
Yes, we would not be submitting a budget that would have debt service payments that would be that high.
So the
Because-
town manager negotiates
I-
with his departments.
Yeah.
So
You're
we
going to
would-
have to wait, or you're going to get what you
Yeah,
want.
and so who sets that 5 to 7%?
That is the town's policy, that it's the town manager, the select board. It's been presented to the finance committee, but it's not adopted by the finance committee. It's adopted by the management of the town.
But isn't that just for the small items, the 5 in this long 5-year capital plan, right? It's not
is.
schools, it's not major,
Boilers, things like that.
major expenses.
It is for debt that is financed within the levy limit, so it's
Right.
not excluded debt, and pretty much anything outside of a major building project would be, the intent is to fund that within the levy limit.
So how, I want to take just a step back, and in here, in the document, it said that, it's anticipated that both the schools and the town will need an increase of 3 to 5 subsequent years. So, okay, so, that's good. That's good information. But how does then this other debt service feed into that? If there's more money needed in the capital plan, or the small funds that we need, or the small projects that are funded under the capital, within the debt, within the levy limit, right? Okay. So with that, do we go back and say, look, you want to do X, Y, and Z, want these capital projects X, Y, and Z, so how then do you decrease your operating budget? I mean, do we do that at all? I mean, how?
We don't. We don't, because as long as the town manager can manage to within the policy range, then that doesn't impact the way they discuss operating budgets with us, because we're considering them to be meeting that policy goal.
Right.
So does that policy goal then mean it's the operating budget and the small debt that the small capital project fall within that 3 to 5%?
Yeah, so another way of asking the question is, that debt service that for these small items, is that in the 87 million? Because I don't see a separate line item for town debt service, only for the town. Does that make sense, my question?
It does.
It is, debt service is part of the non-guideline.
So, but I see for the schools, the 3 schools, where is the debt service for the town stuff, the Mickey Mouse stuff, the fire trucks and stuff?
So the debt service for the capital plan is within the town's operating budget.
So
The non-guideline spending debt service is for, well, actually, you have CPS, so this, you have this categorized different than we usually put it together,
This
so
is
I
right out of the
apologize
finance
for
report.
that.
We actually do discuss town small capital projects as part of our guideline process.
We do.
You always come to us and say, we need a new fire truck, we need a new ambulance, or we need, new building improvements and so on. And those are part of the operating budget as far as I can tell. Difference is the school debt is not part of that. School capital project budget discussion.
So it's in the 87.7 is what you're saying?
Town stuff is.
Yeah, the town
The-
stuff.
School,
Okay.
Mickey Mouse stuff is not.
The town manager does allocate to the schools a capital fund for them to manage themselves, so that they want to put new chillers on the top of Alcott. That's within their capacity to do it, because they need to maintain their schools. So am I stating that incorrectly, Carrie, that within the town manager's capital plan, CPS is allocated a certain amount of capital?
About $1 million of the $5 million.
It was 900,000 or something last
And
year.
the debt
not
service for that,
discussed
and the debt service for that
Oh, we
capital
discussed
plan
that
is
here.
where?
We do.
Is it in the operating budget, or is it in
Yeah,
the
we
debt
do.
service?
Absolutely.
It's in the debt
Number,
service.
but we don't discuss that the schools are putting in new boilers or some of the other capital projects,
Right.
like, over the last few years, STEAM lab.
Right.
That's not discussed in this meeting, per se. It's not part of the school budget.
Right.
It might be, the number for the schools might be in there.
They typically bring a separate capital article
Yeah.
for the schools
Right.
and we discuss it in some capacity.
Well, we
Maybe we
discuss it when
just
we
in the
discuss
warrant
our-
review.
But
Yeah,
not
town
part of,
meeting.
Yeah.
but not part of the, not part of the guideline process, or not ahead of it, and
Right.
it feels like we're being reactive
Right.
Right.
at the last minute, as opposed to discussing it. So maybe guideline is the wrong word. Maybe it's we want to have a conversation so that we can think about these things before the night of town meeting,
Well,
which is,
they can inform our thoughts about how the operating budget should be set,
what do you
certainly. I think
Why
it's,
shouldn't we give advice about capital expenditures meeting too?
Well, we do.
well, we
do.
do.
We do.
We weigh in on the articles.
Yeah,
We
but
do.
not at the last minute. Why don't we start asking about it now?
Yeah.
So we can have more to go over it and maybe make the whole article better, because people, the questions we ask will cause them to go back.
Right.
Study it.
I think we've spent as much time
Yes.
on this
I'm not
particular
sure we
guy
will.
as we're going to have for tonight, so we're going
Tonight.
to move to the next agenda item. That's, of course, unless you want to not do other things on the agenda, so we can,
Let's keep going.
well,
So
let's
what's the
try.
outcome, Mary? You're going to draft a letter or something?
But
Is that-
we have to,
Yes.
by the end of by July 31st, the current process of guidelines is that each budgeting entity is sent a data request letter, and we will be able to vote on those. If Mary can draft some, we can go over those and vote on those at our July meeting.
So you've got preliminaries
We have
in your
preliminary
packet.
paragraphs. If you have any
Please read
comments,
these. If you have any comments,
forward
let me
them,
know.
forward them to Mary.
I will put together something and we'll vote on it in our July meeting.
Yeah, sounds good. We'll discuss it and vote on them. Okay. So the next thing on this agenda is a special topic that John Hickling has great interest in, and that is trying to find a way to create a stabilization fund for the middle school. Would you like to make your comments, John?
If you'd like me to, Dean, I would love to.
You've
So-
got the floor.
So I went, I think, to the very first school committee presentation by the school committee member Heather Bout on the new middle school project. And at that meeting, she brought up the topic of, I think she put a dollar value on the surplus Peabody property, assuming, that everything goes smoothly with the new middle school. And it was very well received by the crowd and by the audience in that, in that forum. And so, conceptually, we all know we need a middle school. We all want a new middle school. And the debate revolves, sort of around how we're going to finance it. It's a big ask for the community, for the 25% of the population that has kids in the school system, to ask of the other 75%. And it seemed to me that this is a really great way of getting the whole community to cooperate and collaborate on a project that could help defray some of the costs that would be incurred by the borrowing required for a new middle school project. It could take any form. It could take many different forms, and I don't pretend at this point.
But I think your point is that we need to really monetize the value of the Peabody land and building to the degree that it can
And
be
that
done.
could take many forms. Yes, is the
I
answer.
mean, proposals to repurpose it as a municipal building or, that sort of thing will not create the sort of stabilization fund that you were thinking would result if we could somehow monetize it.
I wouldn't think so.
Yeah.
And just as a sidebar, maybe some element of affordable housing could play a role.
Yeah. Yep.
Because that's another town goal that we have.
Right.
And
I think a variety of different things could possibly be done there. I'm sure the folks who live on that particular road would welcome anything that is not streams of parents dropping off children and buses twice a day.
diesel buses.
So there's probably a wide variety of things that would be more acceptable than that.
It just seems to me that it would be a great gesture on the part of the school entities and to bring the whole town into a really collaborative, positive way of addressing this issue. And I don't know if it won't be easy, and I don't know what form it could take. But to get that property back on the property tax rolls in one form or another would be an ongoing benefit, to the town. And so, the dollar number that I heard mentioned to the value of the property was 10 or 11 million dollars. I have no idea if that's under what, conditions that would be the case. But anyway, I just think it's an idea that is worth fully exploring. And so I'd like to see some kind of commitment to explore it.
Well, thanks for your comments. Anybody else want to comment on that?
Are you talking about something similar to what they did with Emerson? The umbrella? That building used to be a school, right?
It's not really clear what might happen on the property,
Right.
but I think what John's proposal is really trying to do is find a way to mitigate the costs of the debt service. And to do that, you need to somehow find money to come out of the resulting surplusing of that land. If we were to just take the building and convert it into a new arts center like Emerson, and rent it for $1 a year, that will not satisfy
Right,
the...
and I'm not, I was just saying, though, that
Yeah.
that used to be a school, and now it's something else, but the
Yep.
town still owns the building. So you're not sure if you want to keep the building, if you want to get rid of the building, tear it down, sell it, whatever.
I'm not a real estate expert. I assume that building is a demolition.
Yeah,
Is that incorrect?
That's a tear down.
It's
Yeah.
probably
It's-
close to
Yeah.
a tear down, if not.
So then,
Could be a really
what's the
big
purpose of the stabilization fund?
To offset the interest costs of the debt required to build a new middle school.
All right.
And that could range from anything of an outright sale to a developer to put 10 or 12 or however many appropriate housing, however is decided by, by town meeting, frankly, right?
Right.
And some mix of affordable or not, again, open question. And, so if it even approached $10 million, where you could stabilize interest payments for $1 million a year for 10 years over the hump of that, debt service chart that Terry has done for us, I think it'd be worth it.
So what's the process, though? It sounds like it's a question for town meeting. It needs to be articulated in a warrant article as to what to do with that land. So, like when Ripley is another example, became kind of, town offices, and part of that is leased out for daycare. But what was the process to repurpose a building?
So that property is under the jurisdiction of the school committee. So the school committee would first have to declare it surplus, and it would go to town meeting, and town meeting would, in a case like this, would typically vote to move it under the jurisdiction of the of the select board for the purposes of disposition. So and typically you wouldn't see a school committee declare a property surplus until the project is complete. So I think that would be the trick. It's certainly good to talk about it now, but whether or not they would be willing to entertain.
Oh, sorry. No, I wasn't suggesting we tear it down while the kids are still there.
No, I wasn't suggesting that either.
That's already happening.
Yeah.
It's a good idea.
Think ahead. Sorry for the flippant answer. I'm trying to...
No, I think it's worth talking about, but it might be a little much to expect them to declare it surplus prior to the completion of a new middle school project. That's all I'm thinking.
Don't you want it to establish a stabilization fund, really to take the lower the first payments that the big pay, in your accelerated debt schedule. So we would really want to have that money built up ahead of the time we start having to pay off the debt.
Yeah. Right, that's the trick.
That's the trick.
That's the
Right.
trick.
So that's why we normally actually build up the stabilization fund prior to by vote of the board of, the town meeting.
Actually,
Which,
these are usually...
maybe a good thing to do, that we would suggest that. I think that would be the select board that would actually kind of bring that to town meeting.
But the debt actually goes on a curve. So I know like the debt for the high school is peaking like next year or something like that. It didn't peak when we started building it. Right?
Right, and there's certainly ways to look at modeling if there was an understanding that, in year 2 or year 3 of debt service, that funds might become available.
Yeah.
So
I mean,
we
it's in
can
essence refinancing debt, like you do for a house. You buy a house, you get a loan, and you sell your old one, you can refinance the new loan.
Yeah, there is that opportunity, and there's also an opportunity to be a little creative in
You mean like
So what-
backload the payments, backload the amortization? a
Yeah,
little bit?
we have some ability to do that. We certainly can't do big balloon payments or anything, but we have some ability to work with a potential opportunity.
So do you know of anything legally that would stop the school committee at whatever town meeting we decide to go forward with a new school, to say, hey, we're going to go forward with this, and one of the requirements is we're going to declare it surplus property upon completion, make that contingent, make the whole warrant contingent on that. Can a warrant be contingent on that?
So wouldn't that have to happen sooner when we're talking about the middle school feasibility study that's being undertaken right now? Wouldn't they?
Would be a good
Shouldn't
idea
it
to
be
start
brought
putting
up at
money
this
into a
time?
stabilization fund.
Well-
Usually we take it from the free cash.
Right.
And start building that
Right.
up.
No, I'm just saying, though,
ASAP.
if you want to if you want them to surplus the building, the Peabody building, wouldn't you want to have that in the conversation now as they're talking about the feasibility study for this?
I think
And
they're
the
very
middle
amenable. Would you like to comment?
Many public statements have been made by the school
Right.
at public meetings where we stated categorically that we will surplus the building to
Okay.
Right.
Okay. All right. So then, Carl, what you're saying is, yeah, we've done that in the past, used free cash, form a stabilization.
To build it up.
Yeah.
So when we need it, we have it. Here, we're sort of looking at something that's kind of a contingent thing out
Well,
there in the
it's 4 to
future.
5 years out,
Yeah.
right?
Yeah.
Well, I think this is something that, we'll be revisiting this as things go along, because that's a valuable piece of property that will pretty much be, extra. Okay, next item on our agenda is correspondence. I don't believe we have any correspondence this
We
month.
did.
Did we?
We had one from Dory Keough.
Oh, that's right. I'm sorry. I don't have that
Letter
handy.
that got sent
Oh,
around
Dory Kehoe, yeah.
Yeah.
about the building committee.
Yeah. Hold on.
Yeah.
It's on at the capital planning committee, right?
Right.
Long range, yeah.
Right.
And she
So I'm sorry
wanted
for-
to include maintenance of buildings, I think, in the purview of the capital committee.
Maybe that's a good thing.
That is a good thing. We should have maintenance reserves, yeah.
Do we have a,
She also brought up the question of having the
I've got it
FinCom
if you want to.
rep have a vote on the Long Range Planning Committee.
That is a touchy subject. That's a tough one.
But she did bring it up.
Yeah, she also talked about whether the timing
Yeah.
was right because there was a new town manager.
So the,
That give him more time to take a look at what he wanted to do before.
yeah, just a comment on the Long Range Planning Committee and the FinCom's role on that. There's an assignment at the bottom. I think that you do the short draw there.
Yep.
And that assignment is more work than just sitting there taking notes. You are expected to be at the table. You are expected to be a participant. And the only thing you can't do is vote because you're not a member of a.
that's good.
So.
Never my fault.
Yeah, it's not your fault, but it's a function of being a finance committee member. You cannot be a member of another committee. Okay. So chair's report. Let's see, I went to a chair's breakfast. Some interesting things going on there. The Tax Fairness Committee, David Carr they are anticipating bringing an article that will try to reduce the amount of complexity associated with some of the benefits that someone would be able to take advantage of under some of our programs. There's a interaction with state circuit breakers, and the enacted stuff, our stuff went off to the legislature, came back, we voted on it again at town meeting. Excuse me, but when you have rights to a circuit breaker benefits as well, which are state benefits, and then you're trying to take advantage of ours, and then you lose your rights to the state. So they're trying to straighten that out at the Tax Fairness Committee. Let's see. So there was a big, long discussion of the tree bylaw, and it's, the process is not as self-regulating as they had hoped. They're working on it, but it's taking a little bit more consulting work than they had originally anticipated. So they thought they might come to us and ask for emergency allocation of funds to pay for consultants to manage their tree bylaw. But the more exciting thing at the planning board is that they're working on allowing accessory dwelling units by right. So if you wanted to have an in-law apartment and that those could be rented by right, you could not condoize them or make it into a two-family that had separate ownership, but you could rent it out. So they're working on that this year. I did ask about whether or not they were doing anything with the depot area and creating more density there, or possible housing above some of the storefronts, or anything. They don't think they have the bandwidth to do that this year, but they are going to work on this accessory unit. The health department is greatly concerned about vaping in the schools. They've taken the small grants that they have, and they're going to take some of the money and literally put monitors in the bathrooms at the high school so that they can try to control the amount of vaping going on. It's really an unfortunate situation. It's really very bad.
Monitors meaning actual people or some kind of
No, monitors
electronic?
meaning electronic surveillance in bathrooms to try to, it's like going to be able to detect vaping or something. I'm not sure exactly how that's going to work. And finally, the Board of Assessors is noticing sort of a trend in housing values, which are going to put more pressure on what we'll call the middle sector of the housing market on taxes, because the very high end has had a certain deflationary effect, and so they're somewhat depressed. The housing market at the very high end is somewhat depressed, so the amount of tax draw that we're going to get is going to come down market a little bit, and there's going to be you push the balloon from the top and it bubbles out somewhere else. So that is something that they're looking at, and I don't know that they have any real statistics on it, but they do think that that's going to be happening. So that's my report. And now I have the finance director, who has a few items.
Did you skip observer reports?
Oh, I did. I'm sorry. I skipped observer reports. Let's go around the room. Anybody with observer reports?
No report, but I just wanted to reiterate, it's great that we're going to have a capital long-term planning committee, but I also wanted to remind everyone that we have asked multiple times for there to be a permanent building committee. And the reason for that was because a lot of our peer towns have them. They could be a good resource for projects, not just the middle school, but other capital projects. So I think we should reiterate our request that that be established. I have a feeling it's been eclipsed by the middle school building committee, but the point was it would cover more than just the ad hoc school building project.
Just a note on that, Phil, as constituted, the building committee for the schools is about 50% either administrators or school committee members, something like that. It's close.
Shocking.
Yeah.
No report. I have a comment or a question though on what would be the observer's report. I did hear you mention the agenda monitor.
Yep.
I missed the two sentences you said.
Oh,
after
okay.
that.
So agenda monitor, basically, these particular committees rarely have a financial impact on the town operating. And so you would just communicate with the chair of that committee and say, I want to be on the agenda distribution. you would receive the agenda for their regular meetings. You'd look at it. Doesn't look like it has any financial impact on the town. You don't have to go to the meeting. You just pass. That saves some time. It's very simple.
So I also observed the Tax Relief Committee, but you mentioned that in your comments, so nothing more to add there. I went to the inaugural middle school building committee meeting, and it looks like a great committee, and it's got lots of school committee members on it, and I'm sure it's going to do just great.
I don't have any.
I went to the select board meeting. Let's see what we had there. Select board meeting. There was a change of proposal for the Concord Market. They are looking to create an event space upstairs at the Concord Market. There was some discussion of the municipal facilities study, which still has yet to be issued. It's been 1.5 years. We have 26 facilities. There are 12 department heads, and they're still working on the municipal facility study. And that's pretty much all I'm going to select board.
Nothing for me.
So Minuteman, a couple things. So we have a new rep from Concord. He's the, Carrie has stepped down after 7 years, and we have a new fellow who's the former town manager of Acton. I haven't yet met him.
Is that Jim? Who's doing that?
Steve Ledoux.
Steve Ledoux, that's the name.
Steve Ledoux, okay.
Yeah, so Steve Ledoux is...
Very good.
Yes, I think it is. Okay. Yes, I think it is. So that's one thing that's changed. Also, Belmont, this is some good news, has created a committee to relook at Minuteman, so whether they want to be in or not. So that's a good development. Enrollment, as we projected, has really jumped up. So they had, for 2020, they had 189 confirmed with 15 more potentials. That's about 30 or 40 students more than they had in the prior years. That's great. And I think I told you a couple meetings back that the athletic fields, there was discussion with Lincoln, which sort of fell to the wayside. But now they're in the process of getting bids on potential business partners for the athletic fields, et cetera. So they have some good things happening.
Good.
Nothing for me.
Okay. Sorry for the delay. Finance Director's report.
That's quite all right. So I'm going to talk to you about a reserve fund transfer request and some line item transfer requests. I have 3 handouts, and I'm hoping everybody has each of the handouts.
There were piles.
Yeah, I don't think
Pass this way. Pass this down.
Okay. Here.
I already have that.
2. So here's one.
So you say there's 3.
The other 2 are coming in the other.
Oh, okay.
which way here.
Well, we can share. This is 3. Do you have any other copies of 3?
I don't know where all those went.
Oh, you know what?
These are these things where they have to do anything. There's 90 days. But they can't finalize it. They haven't closed it.
Oh, good, that's coming this way. Great.
June 30th, so we keep
I think we're short on this one. Do we?
Right here.
Oh, okay.
The copies here.
Okay, great. All right. So I would like to start with the handout that says fiscal 19 closeout. It's the one that's got red marks on it. So as you may recall, the town's budget is appropriated by town meeting in 39 different line items. And so we cannot move money between or move appropriations between those line items unless we go to town meeting or unless we're at the end of the fiscal year and with the approval of the Finance Committee and the Select Board, we can make those transfers. So we are a day away from closing our fiscal year, and I've put together a status on where we stand by line item, town meeting line item appropriation as of today. Anything that is in red, obviously, is where we have issues. However, only the 3 items that are highlighted, the line is highlighted in gray, those are the ones that I'm going to ask for your assistance this evening. But I will go through each of our areas where we need to put some attention to. The first is line item 2, legal services, and we will talk about that in greater detail. But I am asking for both a reserve fund transfer and a line item transfer to close that deficit. Line item 3, elections and registrations. We do have a deficit because we had a special election, and we are going to handle that internally. We have an encumbrance, and then we'll handle the rest with an internal transfer that we're able to do on an administrative level, but we haven't done that just yet. Question?
I'm just curious, what's the total appropriation and what's the total expenditure?
So
It looks like
I don't have.
we actually have a surplus, right?
We do. We now this is as of today. We stay open until July 15 days. So we have a lot of bills that are in process, and each of the departments will have to go through and identify any work that's in progress that hasn't been billed yet, and we will encumber that. So the total budget appropriation is $43,474,850. And I apologize, I have it on my sheet, I guess I just didn't print it out. Expenditures to date are $40,215,424. So we have about a 3.25 surplus at this point in time, but we still have a lot to process and encumber for things that are in process. And I'll give you a report likely at your next meeting on where we're ending. We certainly will have a surplus that we will be returning to become part of free cash. Line item 6, Kai's Road, we have a small, some internal housekeeping to close that. The same on 10, the townhouse, that's the costs associated with operating this building. 18, the snow and ice removal, I will be asking for a line item transfer, and we'll talk about that in a bit more detail. 28 and 30, hunt, recreation, and ceremonies and celebrations, we'll be doing administrative internal transfers to attend to those. And then the last 38, Social Security and Medicare, a line item transfer there. So I think, again, most of these we're going to handle internally. We just haven't had enough time to process. The 3 items that are highlighted in gray, I want to go through. The first is the reserve, is legal. And we, through May 31, because we haven't received our June bills yet, we have a deficit of $228,617 in legal in total, in general fund legal. I think every meeting you've heard me mention legal services. So we had an original appropriation of $250,000. At our special town meeting in December, we received a supplemental appropriation of $100,000, so we had a total of $350,000 to work with, and our expenditures to date are $578,000. And if you look at the reserve fund, the handout you have, reserve fund request form, you can see our expenditures to date, again, through 5/31, because that's what we've been billed for, $578,617.08. So I am asking for a reserve fund transfer in the full amount of $225,000.
So, Carrie, why are we $228,000 over on legal services?
So I can, let me just pull up that spreadsheet. So this is for all of our legal services. And our legal services budget, the $250,000 amount, is really built for what it costs for us to operate on an annual basis absent litigation. So for all of the work that we have town council do, whether it be contract negotiations, whether it would be negotiations related to land purchases, questions the planning board or planning staff might have, that on a typical basis, on an annual basis, is going to cost us $250,000. On top of that, this year, for the last 2 years, we've had the Estabrook Woods matter, and I can tell you, in fiscal 19, year to date, we've spent about $325,000 on Estabrook Woods. At this point, I asked Town Council for an update because I knew you'd be interested to know where we are. The case is in the discovery phase, and I apologize, I'm reading from the email that I have. Town Council has completed the search and production of historical documents, and our archaeological and surveying experts have completed their work, and we are at the point where depositions will begin soon. And so there was a tremendous amount of work that was needed to go through historical records, and that's the bulk of the expense to date.
So I'm just telling you that discovery, you're just in the beginning.
Yes.
It's going to continue at that rate for a while if this litigation continues.
If the case is not settled, and I'll just remind you, there are a number of parties involved in this. One of the parties, Harvard University, has settled. The remaining parties have not yet. There's been no settlement.
Maybe I have a naive question, but we go to town meeting and we ask for $100,000 to continue the Estabrook Woods debate, whatever, and we overspend that by $225,000. Is that correct?
Yes.
And then the only thing that we have to do in order to okay spending that additional $225 is for us to say, yes, we'll take it out of free cash and the select board.
Yes.
So why doesn't that have to go to the town?
So the options would have been to, at town meeting, ask for a supplemental appropriation, which would have to come from free cash, because that would be the only thing available at annual town meeting within the current fiscal year. Or making an assessment that we felt that within the budget we would have the ability to manage that cost in existing appropriations.
Why didn't we go to town meeting and ask for a transfer from free cash if that was the only thing that was available?
Because the options were either free cash,
right,
or to deal with it within the existing appropriation and not expend additional funds. And the decision was made not to seek a supplemental appropriation, because through a series of budget adjustments or budget transfers, it was felt that we could manage this expense. So the reserve fund, the reserve fund has already been appropriated. It's already been accounted for. You're already paying for that in your taxes. So it made more sense when this was looked at to use something that we already had available versus going for a free cash.
There were no other demands on these funds.
Correct. Yes.
So in previous years, we've had veterans, services requiring these funds. There have been other needs that these funds have been used for.
We certainly could have asked for a supplemental appropriation, and then this reserve fund would have closed to free cash.
But I think along the lines of Mary's question, if we went to town meeting and asked for another $100,000 for this specific use on this litigation, why wouldn't we, and the townspeople said, yes, of course, why wouldn't we stop the litigation after the $100,000 is spent, that additional $100,000 is spent? It seems to me that we continue with this litigation, but the townspeople don't know it, and then we're backfilling it with reserve funds that they appropriated for. So I'm just wondering when does it stop, and how, if I'd be really upset if I was a townsperson and heard this for the first time
Which is
now.
probably why they didn't want to bring it up at town meeting.
Exactly.
No, but they
No,
did
they
bring,
did.
well, at this town
They
meeting,
came,
but
they came and said
Well,
they
well, I
weren't
mean
even
for-
appropriation,
for
and our
what they
comment
really-
at the time
they were there
was,
last
But I
October.
mean,
That was
for
at the
full
special
amount.
This is
town
the
meeting.
special
This is-
town
The full
We're
amount.
talking about the regular town meeting.
So I think at every finance committee meeting, you meet on a monthly basis, I've mentioned to you that we've had a discussion about Estabrook. I've given you an update on Estabrook and that we had exceeded the budget and that we would be looking for a reserve fund transfer. I think that has been very transparent.
So Carrie, I'm just curious, for next year, fiscal year 20, what is the appropriation for legal services? Does it take into account that the case might continue above and beyond sort of normal legal expenses that we've incurred?
Let
Or
me
are we
just
going to be in this situation next year?
let me just double check. I think we added a little something to the
I think I remember it was
Budget,
not
but-
anywhere near $550,000.
right. It's
It was maybe 250 or 275, but not, so if continues, you're going to be back before us next year asking
Well,
us
so
for
now,
another
so then that leads to the
$100,000.
can we do something proactively now to at least set aside money in the reserve
Well,
fund for next year? That
you
I
have
think
to.
this is something the town meeting should decide. You know, I think there's nothing you can do about it. The money has been authorized, and the lawyers have spent the money. We owe the money to them.
Right.
But this is something the town meeting should look at for future expenditures. Right now, there's not enough money in the budget, so if it continues at this rate, we're going to be at the same situation.
What was authorized? The $100,000 was authorized by
Right.
the citizens of the town.
That's right.
And then it's been exceeded by, you know,
200,
So
300%.
Some of it was going to be
Yeah.
within the usual appropriation for legal services.
No, it would have been,
but in terms of all the line items here, this is kind of
so
it would have
just-
been authorized by whoever is in charge of that litigation, if it's either the town manager or the select board. So they authorized this deficit spending.
Just to be clear, the supplemental appropriation at the special town meeting was $100,000 for legal services. It was not for any particular matter.
right. But back to, I think, Dee's question, how does this get in front of the citizens to say, we can take the pain or we can't take the pain? Who makes that decision? Is it being made by the select board? Is it being made by the town manager?
So the case is managed by the town manager in consultation with the select board.
So I'm curious, you said Finance Committee and the Select Board have to approve this, right? I'm curious, has the Select Board discussed this, and what's your sense of what the Select Board's sense is?
So the process that we follow with the reserve fund transfers is we bring them to the Finance Committee first. And then, assuming there is an approval, it would go to the Select Board at its next scheduled meeting, not Monday, but on the 15th, July 15th.
So they haven't discussed the matter at all?
They have not discussed the reserve fund transfer.
So here's
Because
a,
if it's not supported by the Finance Committee, then I don't bring it to
so
the
here's a what
Select
if.
Board.
What if we balk here? What happens?
Then-
We're in deficit.
Then we would be looking for a line item transfer.
We've got to pay the
The
money.
reserve fund,
Yeah.
the reserve fund is for extraordinary expenses. Line item transfers can be for anything.
Right.
And is an ongoing litigation considered an extraordinary expense when it
Well,
was an ongoing litigation?
I think when we talked about this last year, because I brought a reserve fund transfer for legal
Yes, you
last
did.
year,
Yes, you did.
that it is up to the Finance Committee to determine what is extraordinary. State law says either unforeseen or extraordinary, but it doesn't define what that is. And I've worked with a number of finance committees that have different interpretations of that or understanding.
Can you help me think through a line item transfer? So if it doesn't come out of free cash and it comes out of a line item, what does that mean exactly?
They take it from
Not
some
an
surplus
underspent item.
department, some department.
So it
Yeah.
comes out of free cash a different way?
No,
Because it's a lower.
No, a
It comes
department
out-
that didn't spend its appropriation would say, okay, my allocation can be transferred over to here. We're going to transfer. But we also have to approve these.
But if I understand, we take the
Right?
total here, and if we've appropriated more than we've spent, that excess goes into free cash, right? So if we take this, and if we don't take this out of free cash, we take it out on a line item, it changes the total.
Means
So then we
less would
have
go into
less
free
to
cash.
go back to the
Less
free
free
cash.
Yeah.
So it's
No,
free
you're right.
cash now, or it's free cash
Well,
down?
Well,
but
it's not
these are existing appropriations that the town has made, that town meeting made for the town operation for fiscal 19.
I see. So then it would show on a line item as being overspent.
Carrie, can you,
I would need to make a transfer, so
suggestion.
I can't close a town meeting appropriation with a deficit.
All right.
Okay.
I think we've sort of exhausted the possibilities here. Can we?
could I just ask one more
yeah.
question about the administrative account? You said that some of these other encumbrances might be able to be handled by an administrative account?
Administrative transfers. So there are, if you look, I know you have your finance committee report. In some of these line items have an A, B, C, and D. They have sub-line items. We have to balance by the town meeting appropriations, which are, these numbers 1 through 39. So there are some transfers that could be made between the sub-line items that we can do administratively, but between the major line items, town meeting appropriations need to be done through this process with the approval of the finance committee and
Okay, so
select
internal
board.
transfers, as you had said before, the administrative account, they come out of a sub-line item, but that just means there was
the ability to do that.
the ability to do that, and also there was money available to do that.
Yes.
Okay. And so then that doesn't come out of that doesn't go into our free cash either, when you make those transfers.
Right, but I just want to be perfectly clear. Town meeting appropriated this money for town operations, and the town is going to underspend
Right.
by a certain magnitude that will return to free cash, or be part of free cash.
Dina, I move that we approve these transfers, but I will just say this, that I'm observing a disconnect between our approving extraordinary expenditures and the authorizing body approving the events that led to the unexpected expenditures. We should have some mechanism in which the select board can know that we're going to spend, if you continue this path, you're going to overspend by $250,000 or $350,000, rather than come to us at the end of the year and say, oh, we didn't know, what was. I happen to see this all the time. I litigate against government entities sometimes, and the agency that you're litigating against goes crazy with the litigation. They don't have to pay. It's the general fund that pays. So I think there should be something that links the person authorizing the legal expenditures with the expenditures, so they can understand the ramifications of the decisions they're making. Right now, it sounds like they just say, go ahead, have at it, and then they come to us to say,
Right.
we're
Oh,
overspent.
so Phil, I agree about the connection, but I think on the flip side, it should be our
Can we get a
responsibility to
second
support
for this motion?
I second the motion.
Okay, fine. Now we can have this discussion. Go ahead with your discussion.
I agree with you on the connection, but I think also it's our responsibility to make sure we're supporting a previous town decision to actually litigate. Right? And then I agree that maybe some mechanism for whoever the decision makers are to periodically look at where they are in the status of the case and decide whether they want to continue the litigation, which clearly occurred here, but there wasn't a feedback loop, although, Carrie, you said you've reported on this through the FinCom on a monthly basis, so maybe it's just, I'm not sure what happened.
I
but-
keep pretty careful track. I had no idea it would be this much, and I thought there'd be an excess, but not this, a lot.
Any further discussion? All in favor of Phil's motion to approve the transfer sheet? Right? Say aye.
Aye.
Is that everything
this
on
is
the
the-
transfer sheet?
Everything on the sheet. The sheet.
So you're doing both the reserve fund transfer?
Well,
and-
let's,
I don't need you
okay.
to approve everything on that sheet.
okay.
How about the reserve
So,
fund transfer?
Reserve fund transfer
Yeah.
should be included that we just discussed extensively in the motion, is my understanding. And all the other proposed transfers that,
And the other proposed transfers, just to be clear, are on the sheet entitled MGL Chapter 4433B Transfers, not the,
well, they're,
because
Okay.
there are only 3 line item.
right, okay,
Okay.
thank you.
Line item transfer for the snow and ice removal?
Yes.
The,
Yeah. And
The ones in gray are then also listed
Right.
on this other sheet.
So that makes the Eagle excess add another 40,000 to it. So it was 28 over.
Well, it's,
Up to June, we're going to have another 50,000, so it'll be 80,000.
and that is an estimate, and I tried to err on the conservative
So you have enough.
side, so right, so I don't have to come back to
all
you
right,
again.
so I think we've taken care of your,
Okay.
So Carrie,
Thank
when
you.
you're doing the financial statement close, are you going to have to book contingent reserves for this litigation?
No, we don't do that.
You
We
don't do
we would footnote it if it was in the annual statement, if it was of a magnitude that it may impact the
fund
materia,
balance?
I can't even say the
Yeah.
word of the, right.
Right. You
And
don't have to accrue it? You don't, if something's, estimable and probable, the same rules you
no,
have for
we
GAAP,
don't.
you don't have to accrue
We
it?
don't do that, no.
So Carrie, you have this addressed to Tom, signed.
I know, you'll notice
Oh,
that the
I'm
one I'm going to sign, I've corrected that.
I apologize.
Are you
It
going
was
to
an
take a vote or
oversight
what?
on my
Oh,
part.
we did vote.
No, you didn't.
We just voted.
We just
You
voted.
didn't ask for,
Yeah, we asked for a vote.
Yeah, he did.
And-
He
you didn't ask-
That is for any opposed.
I'm opposed.
Okay, we have
I'm
Mary's opposed.
I'm opposed.
I'm sorry, all in favor? No, I said all in favor, say aye, and we all raise hands except
You know
Mary,
what,
but I
though?
didn't ask for
think
those opposed.
maybe- but-
I'm opposed.
Mary's opposed.
Yeah, but
Sorry, we did
Mary's-
not ask for
Are you
opposed.
opposed to the snow and ice removal? I think we should do the 3
I'm
Okay.
separately.
But just opposed to
All right. So in the discussion, you should have made some sort of a motion that we're voting on a subset, if you'd like to approve some of the subset. What would you like to do, Mary?
I don't
We needed,
approve of the reserve fund transfer of the 225.
okay, so what
228,000.
we voted on
I
was...
agree with the litigation, but I don't like the process that we used to fund it. That's my comment. So I would oppose this.
Okay, so let's break it into pieces. That's the easiest way to do it. So Phil, could you just withdraw your motion and we'll have a, okay? So we'll have a motion on the MGL Chapter 44 sheet, which does have some legal services. Mary, are you?
Yes, it does.
Are you
Yeah, that's
okay
fine.
with
That's
those?
fine, yep.
Those are okay. So we'll have a motion. Can I have a motion?
Make a motion to approve the transfers on the sheet fiscal year 19 MGL transfers.
Okay. Second?
Second.
All in favor? Mary? All opposed? Okay, that's good. And now, the reserve fund request for $225,000 from the reserve fund.
Right.
I need a motion on that.
Make a motion.
Okay, Rashar, a second?
I'll second.
Second, Dick? Okay, discussion? All in favor of that fund request? Opposed? 2. Okay,
Thank you.
all right. Are there any comments from the public? Step here, Ms. Ackerman.
Step right up.
Just very quick, because it's getting late.
Identify yourself, please.
Terry Ackerman. I'm on the select board, but not speaking for the board. Just wanted to thank you guys for supporting the capital planning process and say that to answer one of your questions, the maintenance that Dory Kehoe brought up, that is absolutely in the charge, draft charge, and as well as addressing some of the permanent building committee items, which are, there's an overlap with maintenance and operational costs. We're trying to get a handle on that whole thing. A couple things that you might want to have on your radar in getting comments on this capital plan. I've had 2 or 3 people mention to me that perhaps that they think the finance committee should have a vote on the committee, and that you might want to even consider, because when I used to be on the finance committee, this was always coming up. You might want to consider looking at a bylaw change at some point, so that finance committee, because I think you're the only committee that cannot be on another committee by bylaw. So to maybe look at revising the bylaw. I personally think it's really important to have the finance committee involved in capital planning, very involved, and to not have a vote, that doesn't make sense to me. So it's just something that several people have mentioned to me. And then finally, another thing that's come up, you had a very thoughtful discussion about guideline process, which was excellent. When the middle school was being considered, some of the environmental groups like CSEC are talking about a lot of green measures that they want to put, for example, into the middle school and other future buildings. And thinking that through a little bit, the debt service might go up because we have to put a higher investment into the building, but the operating costs for the building might go down. So that might impact the way you do guidelines, because right now the debt service is in the town portion. So it's something that you want to be thinking about in the future. Does that make sense?
Makes sense. It's not clear how we would model it.
Exactly. I'm glad that's not going to be. Thank you.
Thank you, Terry. Anyone else from the public? Okay. I'll take a motion to adjourn.
So moved. Second.
Okay. All in favor, stand up. Okay.
We skipped this entirely.